So guess what? There's a brand new infomercial on this joke of a radio station, KABC here in Los Angeles. And of course, it's presented as a bona fide radio show. And of course, they're trying to get you to come out to one of these sales pitches that they call a seminar. And they're trying to sell you this absolute garbage called fixed indexed annuities, which consumer advocate Clark Howard calls a danger to your financial health, and which Kent Smetters calls terrible ideas for older people, even though they're peddled to them. So in one of these smart money fundamentals infomercials, the host at one point said,
"Nothing that we say has been fudged, massaged, or nudged over a little here or there."
Well, I'm going to let you be the judge as to whether anything has been nudged, fudged, distorted, or cherry-picked. But anyway, first of all, whenever you hear an infomercial on the radio, you have to ask yourself, why are they paying for all of this expensive airtime? Are they doing it for charity? No! Insurance companies pay obscene sales commissions of typically 7 to 10%. Some have been reported to pay upwards of 20% of the amount that you invest. But so by comparison, how much commission money do index funds pay? Zero. Can you say conflict of interest? There's a famous quote, follow the money will always lead you to the truth. And now we know why these annuities are constantly pushed on us by people who pay for airtime. And when you buy annuities, even though you don't pay Mr. Advisor any fee or commission, that 7 to 10% commission that he earns behind the scenes, whatever it may be, it has to come indirectly from you. And in the case of index annuities, it's baked into the calculations. For example, you might get a lower participation rate, lower performance cap, or it's reflected in the hidden fees, like in these guaranteed income riders. One way or another, it has to come from you and only you. So the guy who's selling these annuities, to make his case, he says,
I'm a believer, particularly as one nears retirement or is retired. Certainty of results and certainty of performance should be of paramount importance, utilizing a system that is tested, proven, and guaranteed.
Okay, so I look at this statement and say, yeah, a low-risk portfolio of stock and bond index funds that is heavy on the bond side is tested and proven. Check. Are they guaranteed? No. But do they need to be? No, they don't. Because they don't need to be because they're consistent. A bond-heavy portfolio is not wild and crazy like if you were to invest 100% in stocks. Have you heard the phrase, when stocks fall, money runs to the safety of bonds? Money has to go somewhere, and never in the history of the markets has there ever been a mass exodus out of bonds and stocks, even during the Great Depression. Never. By the way, if you're looking at 1930 and 1931 and saying, well, that looks kind of scary, actually, when you adjust for the double-digit deflation that we had back then, at no point did a 25-75 portfolio ever lose money. Also, the stock market back then was unregulated. Prices were artificially inflated leading up to the crash because of fraud. There was no entrenched money like 401ks and mutual funds to hold up the market back then. Don't expect stocks to drop 90% again, but at least it's nice to know that even back then, no conservative retirees were jumping out of buildings. Remember, stocks are risky, bonds are slow, boring, and consistent, and when you own both, history has repeatedly demonstrated that you don't need some insurance company to guarantee your money in exchange for mediocre returns on investment. And I'm going to show you shortly just how mediocre index annuity returns are. And by the way, index annuities don't even fit this guy Ray K's criteria, because while index annuity promises are guaranteed by the insurance company that writes the contract up to stated limits, if that insurance company becomes insolvent, then it's up to your state's guarantee fund to pick up the tab. And some states may not cover 100%, in particular California, which only pays up to 80% not to exceed $250,000. Also, in the event of a systemic failure of insurance companies, the state guarantee fund might become tapped. Then what? So basically, annuity guarantees are not guaranteed. So next he starts talking about how stocks and bonds, he refers to them as a cookie cutter portfolio. And he says that they're paying too low of an interest rate. He's just talking about bond interest rate and stock dividend rate. But the catch is there's two components to stock and bond investments. It's not just about dividend rate of stocks or the interest payment rate of bonds. You also have the value of your original investment that goes up over time. And by the way you calculate the efficiency of an investment is not by just dividends and interest, but with annualized return on investment, which factors in, for example, with stocks, not just dividends, but share price. And if stock dividends and bond interest isn't paying you enough each year, what do? It's so simple. You sell off a portion of your principal that has been growing and compounding. So right now, the S&P 500 index and the total bond market index, they're paying really low interest rate right now. But it doesn't matter. And by the way, with annuities, once you annuitize the contract, once you turn on that income stream from an annuity, the growth of your money permanently stops. It's kind of like converting it into an immediate annuity, and those fixed payments don't wait around for inflation. But unsophisticated investors are so focused on the now, I want 6% right now. They don't think about the future when inflation dwarfs those fixed income payments for life. If you don't understand how inflation dwarfs those high fixed payments, you need to watch this video. Dumping money into an immediate annuity or annuitizing a contract is like deciding that taking a vacation at age 65 is more important than having food and shelter at age 85. Also, the insurance company has all sorts of creative ways to erode the death benefit value of index annuities. If you get one of these toxic guaranteed income riders, any interest payments made to you are also subtracted. So in this infomercial, the guy goes on to talk about a woman who had a little over 1% return over the last 16 years with 60% in stocks and 40% in CDs and bonds. And I'm like, what the hell is he talking about? First of all, putting money in CDs is not investing. You invest in bonds and stocks. Okay, so a 40-60 portfolio from 2000 to 2016 provided an annualized return on investment of 5.4% per year, not 1% per year. Or a 28-72 portfolio, even lower risk, 5.8% annualized return on investment. So then he goes on to talk about 2008 and how a lot of people got hurt. And then he's talking about
with index annuities, when the rally came, they made pretty good profit.
According to Advantage Compendium from 2007 to 2012, the average annualized return of all index annuities in their study was just 3.27%. Their worst index annuity returned 1.2%. Imagine being that guy. The very best returned 5.5 per year, but of course you don't know in advance which annuity is going to do best. But think about that. The very best index annuity returned 5.5%. And so by comparison, how well did the really conservative low-risk 2872 allocation into bonds and stocks do during the same 5-year period? 6.7%. So again, who's doing the nudging here? And would you describe 3.27% as
pretty good profit?
And remember, this period of 2007 to 2012 includes the big 56% stock market crash from late 2007 to early 2009. Folks, the bottom line is that index annuities were designed to compete with CDs. That's right, lowly CDs. What kind of return on investment are you going to get with an index annuity moving forward? These products are so complex that it's impossible for the average investor to figure out if they're getting a good deal or not. But according to Annuity Think Tank, which promotes annuities, that's important. They're promoters of annuities. And even according to these guys, moving forward in today's low interest rate environment, you can expect to see index annuity returns in only the 2 to 5% range. And when you reverse engineer index annuities, it's very easy to see that insurance companies cannot pay out stock market-like returns. If they're paying Mr. Advisor a 10% commission and they have overhead costs and they're for-profit companies and they're investing 94% in bonds, only what remains can be earmarked for you, the annuitant. And insurance companies are not stupid. They're not playing Santa Claus. They hire armies of actuaries who make sure that the insurance company is going to come out the winner.